and welcome to the Market Outlook for the week of October 24th. This is Jeff Bish, president of MarketGauge.com, and I'm filling in for Keith this week. And this week, as we always do, we're going to go over the technical setup in the major market indexes. We're going to look at the overview of the market internals and industry groups. And I'm also going to show you an ETF that may be the ETF to watch for determining whether or not this market that can't seem to get out of this range is likely to break out to the upside or not. All right, but before I get to all that stuff, if you're just finding this for the first time on YouTube, please like us and subscribe. Also know you can find more information just like this or find this article video every week at marketgauge.com/outlook. And if you are a Twitter follower, follow us on Twitter at MarketGauge and at MarketMinute. All right, let's get started. So we're looking at weekly charts right here, and the reason I'm looking at weekly charts here because I think it really highlights where we are. This week was a really quiet week in terms of range in the SPYs, in the Qs over here on the right, and in the IWMs, especially over here on the lower right. Now, the big picture here is really illustrated by these trend lines. This is a closing trend line on a daily basis, just that we're looking at the weekly. But the big picture, and some of you may have seen this in the blog post I put out during the week, is really that until this market breaks down below this 212 level, I think you got to give it the benefit of the doubt. Now, SPYs are likely to be the first one to break down if they do, so keep an eye on them closely. Close runner-up here would be the IWMs. If we go down and look in the lower left, that big level is the 120, and you'll see that 120 level lines up really nicely with the trend line that comes in from the lows of the year. So we're at a huge inflection point on the support of these two indexes, and we're also on a huge inflection point if we look at the TLTs. So the reason I have the TLTs illustrated here again on a weekly basis is because you can see that this blue line here is 50-week, equivalent to basically the 200-day, and it's sitting right on it, lines right up with prior support, and had a consolidating week. If we look at the Qs are the ones that have been leading the markets higher. These are the ones that really broke out and have managed to stay above that breakout. And this trend line here was done on a daily basis, and it took the daily close in here, a daily close in here, and you can see that it lines up really nicely with how the market has traded if you ignore Brexit. So I'm admitting I'm ignoring Brexit there, but that line has a really good definition of how this market has been trading. If we put all this together, it makes figuring out what to do next week, in my opinion, pretty straightforward. Unless the markets break down below these black lines, and I'd even say unless they really break down below last week's low, sit tight, see what happens. On the upside, I don't think you can get too excited until SPYs really break out of this multi-week. It's now a 1, 2, 3, 4, 5, 6 week consolidation here. You've got to break to the upside before we get too excited to the upside. And I would say the same thing about IWMs. You really want to see them over 125 before we get too excited. However, if the Qs do break out of their weekly high and basically get over this 119 level, I think it is just 118 level with some conviction, that's where you might look for some upside, even if these other two indexes don't get out of their own way. All right, so let's take a look at the market internals from the little big view portion of our site to see if we can decipher what might happen, what direction the markets might take. So if you're not familiar with these indicators or where I'm finding it, you can just go to our website as I bring it in here. Go to our website, go blog and free tools, little big view, start with market overview. This is how Keith guides you through this each week as well. The highlight here really, and Keith said it last week, not really a highlight, more like a low light, is that the accumulation days are miserable. Last week they were all zeros. So that means over the last 2 weeks, the number of days where you've had an accumulation day in these indexes is 1 or 0 with the diamonds, 2 in the SPYs. As you can see, price action hasn't gone down, but it certainly is not bullish, and the distribution days far outnumber them. So as much as that support level is really the key level to break, the market certainly is kind of in a funk or a haze, and you just got to be careful if we start to move lower. If we look at the sectors, they paint the same picture. And that picture is that it's a market that, while it isn't going down, appears to be getting weaker. The easiest way to see this, and we update this at the end of the week each week, is this daily view, which takes the accumulation or the summation of the number of sectors in the table above, which I'll show you in a second, and illustrates it with a histogram. So 5 on the green bar here means that 5 of the 14 sectors above have a positive 6-month change. -9 means 9 have a negative 6-month change. So you don't want to see this deteriorating. You don't really want to see it get down to 4 or lower. And if you get below 4 or lower and you're below the 200-day moving average, then it's a real dire warning. But this is basically telling you that if this breaks down, it doesn't have a whole lot of support. All right, it does not have anywhere near the kind of support that any of the pullbacks, this one maybe, or even this one initially, had. All right, so it's getting weaker. I'm not projecting that we have to sell off and break, just that if we do break below this level, it's a really serious break. Now, let's go take a look at kind of the details behind that, because I don't want to sound too unnecessarily bearish when there is some reason to look at this situation, as the market has had a pretty significant sell-off, even a broad sell-off, as we'll see in just a second when we look at the McClellan data. And that means that if the market does start to turn up, what's it going to take to really get it moving? Well, if we look at the 6-month change, we can see that the number of sectors here, that yes, they're down on a 6-month basis, but all in, these 4 sectors are down less than 1%, right? Which means if the markets start to rally, XLY, which had a nice day today, could easily turn negative. XLB could, positive. So could XLB, so could IYR, so could IYT. All right, and then we'd be looking at completely the opposite, right? We would be looking at 5 negative and 9 positive. The picture would look completely different, and that could happen in a day or two if the market starts to head higher. All right, so yes, things are weak, and yes, they have gotten weaker. That's actually a positive in my mind if the market starts to turn higher and gain some momentum. All right, so let's go take a look at another way to look at how weak this market actually is or was, and the market breadth. So if we take a look at the first measure that we look at, the advanced declines as measured by 3 different indicators, right? A 5-day rolling average of up-down volume, the McClellan oscillator in the middle, which looks at advanced declines over longer periods of time, and then a rolling sum of the 10-day advanced decline line. What we want to see in these is to have them at an extreme, all right? And have, when you get to that extreme, some kind of a reversal pattern. Now, it has been my thought that this head fake down here with a relatively oversold level here could serve to produce a bottom. That said, I have to admit that if that were going to be true in a really straightforward way, the market really should have gone right back up to the top of the range. The fact that it hasn't makes this head fake idea down here a little bit suspect. Nonetheless, as I've been saying, theme for this video is definitely don't count this market out until it breaks this line. And unfortunately, the advanced decline data right here really isn't going to give us any strong decisive action one way or another. We're stuck right in the middle of the range, and this is stuck in the middle of the range. I don't like to overanalyze stuff, and this is definitely a chart that is not worth overanalyzing. If we take a look at the same view on NASDAQ, it's really more of the same. All right. Again, sitting right in the middle of the range. Yes, we got a little bit oversold. We didn't really get a huge reversal type pattern. The more bullish situation in NASDAQ suggests that from a price action point of view, if it can get going, now this is the broader index. If we look at the Qs, the number is really closer up to here. But again, this is not giving you any real insight into an inflection point, an immediate reaction. It's not overbought. It's not oversold. Don't overthink it. Don't even doesn't even register into the equation at this point. Now, if we look at the new high, new low data, this is a little more concerning. What's concerning about it is that this trend should not be down, and we don't want it to be under the 70 level after being over the 70 level. What we do want to watch out for on the negative side is to see that the absolute number of new lows starts to climb. All right, if that's, or in this case it's the reverse, it's going to be pointing down. But if we start to see a higher level of absolute new lows, as I'm going to show you we have been seeing in NASDAQ, that makes, again, the market weaker and more negative. So if or when this breaks, keep your eyes on the number of new lows here, and this will most likely be already heading down. So this is an early warning. It doesn't necessarily mean we have to break. Again, it goes back to the same theme. It means that if we do break, this is not a break I would expect to reverse. All right, so be really careful if it breaks there. Sorry to keep saying that, but all of these things support that theme. So let's take a look at NASDAQ. You can see that NASDAQ, this is exactly what you don't want to see. When I said an expanding absolute new lows number, that's what you don't want to see. And you can see what the net result is, that this really is trending down. That is not what you want to see either. That said, until the price actually breaks, this is just an indicator. If all the breaks start to happen, this is pointing to a situation where it's weaker, not stronger. All right. So when we sold off back here, you can see that the market, while it wasn't really strong, was definitely better off than it was here, and it was also coming off of a lot more new highs. So not surprising that it rallies back up. That's not the case here. The new highs have been going down, even though the market's been going sideways. All right, so not really what you want to see, but not it's not the fat lady singing yet either. So let's take a look at the volatility or the market sentiment. And this really paints a pretty good picture of what happened in the last week or two. And that is that the market got everybody scared, which we have pointed to, down at the bottom of the range. Volatility got up to the top of the Bollinger Band. VIX got up to the top of the Bollinger Band. This very often puts a floor on the market for a short time. We've worked it off. All right, so this sitting right in the middle of the range here doesn't give us any real advantage one way or the other. We want to look at it when it's at an extreme or when we start to see it crossing over in a major way these other moving averages. It's doing neither. So let's take a look now at the last internals chart here, the VIX ratio. And this also, we want to see it at an extreme and then rolling over. That's what we got here when it started to break. But as we just explained, this held and now heading back up. For all intents and purposes, this too is kind of in the middle of nowhere. All right, so if I sum all that up, and we can do it right on this chart. Key index to watch is the SPYs along with the IWMs. Those are your big numbers. Until either one of those gets broken, it's just more of the same. If we do start to head up, look for the number of industry groups over in the sector view to start ticking up. Also, look for new highs to tick up. Also, if you're going to play an index to the bullish side, best one to play is probably the Qs. So let's just see if we can get a little bit more insight into which way the markets may be going by taking a look at some real motion charts. Now, the reason I'm looking at the real motion charts is because real motion is going to show us the momentum that you can't see in the other charts that we're looking at. If you want to learn more about the real motion stuff and you're watching this over the weekend, we just did a training session on it, free training, last Thursday night. The replay is still available up until the end of the weekend. I'll put a link in the text so you can go check that out if you'd like. And the way the real motion chart works, let's take a look at the IWM here, is essentially that you've got your momentum-based indicator down here. Now, this is a proprietary indicator we call real motion. You're only going to find it here. And the simplest application of it is simply to know that these dots are a one-day measure of momentum. The blue line is a 50-day measure. The green line is a 200-day measure, and as a result, these line up really nicely with the 50-day moving average and the 200-day moving average in price. So we look at it as a confirmation and a leading and lagging indicator. So for example, when this crosses 50 over the 200, and it does it before the overall market in price action crosses, it's a leading. It's telling you that the market is stronger in its momentum than the price action shows you on a normal chart. Now, you can also use it when you just compare the one-day action to the individual moving averages. So in this case, you can see the one-day action was well over its 200-day measure when the price action was below it. So that's bullish. This is bullish. And when it pulls back to retrace in here, and this is only pulling back to its 50, and there, you can see it's just a much more bullish looking chart. And so no surprise when you get a nice rally off of it. But look at where we are now, right? In IWMs, yes, we're holding this level, but the momentum is under the 50. Significantly. So it's basically telling you that the momentum is right in sync with the negative look to the IWMs. Again, you want to always trade the price, and this 120 is a major support level going back. So we need to see it break first, but if we break first, we don't have the same momentum strength that we did back here that was actually holding above the 50 as the market was breaking below the 50. All right. So in terms of the IWMs, they did a really great job on momentum and real motion at telling us that as the market was turning up, it was a turn up we could trust. And right now, I would say they're doing their job in telling us that if IWM breaks down, this is not a breakdown you want to anticipate is going to snap back easily. Now, the other thing that you want to look for here, and if you are a Real Motion member, please take note of this, because this is where Real Motion really gets powerful. And that is if the market does head higher and trades up, maybe it trades all the way up to 125, and the momentum cannot get back up over this 50-day moving average, that will be a huge red flag and a huge warning that we could be looking at a double top. All right. So obviously that's going to take some time. Probably not just this week. Could happen in 1 week, but that's one pattern you absolutely want to look out for. Now, with Real Motion, we can look at all the other indexes, and Qs are basically Real Motion is traveling right in line with the overall price, so we'd follow the price. SPYs, more or less the same thing, but one thing we want to watch out for on the SPYs is we can see that the real motion is getting down here close to its 200-day measure. We don't want to see that breaking the 200-day measure with this still hanging up here well above the 200-day, right? It seems to be leading to the downside. Once again, if the market heads higher, we want to make sure that the momentum breaks its 50 also. Otherwise, we could wind up with a situation like we saw back in the end of 2015, where if you notice, the real momentum was not coming back up over its 50-day moving average, and 50 was below its 200, while the price action was actually bouncing on the top of the 50. Once it broke down below the 50 and around it, the momentum never even got close to the 50. And then, as you can see, when we broke the key level support, it really fell out of bed. Now, I'm not going to predict we're going to have a flash crash just like this, right? But what we're seeing, what we will be seeing if the market breaks to the upside, and this doesn't, will be the beginning of this type of a pattern. And it's incredibly powerful when it resolves itself in the direction of that major divergence. Now, that all sounds terrible and perhaps really bearish to a lot of you, but let me show you the flip side. So the flip side, I talked about this in the beginning of the video, was that when we were doing the training, I have to give one of our attendees credit. He asked me to take a look at this particular ETF, one that I hadn't been watching, but really wish I had known about earlier. That said, I haven't missed it yet. So this ETF is the MSCI Euro Financials. So essentially, it's a good measure, a good proxy of the financial companies in Europe, right? This is where all the bad news, as you can see, has been in the last couple months. But look at what the momentum indicator is doing. The momentum indicator actually turned up here. The market didn't break its resistance to move higher, so the price didn't confirm it. But when the market made a new low, the real motion has really stayed in pretty good shape. And we have a divergence on the 1 day. We have a massive divergence between the 50 and the 200. This is what I was just showing you in IWM. So you can see this is already crossed. This hasn't crossed yet. Momentum is breaking out over months and months where price is not. So when we add all this up, this is a scenario where if the index, the price itself, or the ETF gets going, I would say the first sign of that is to break higher here, second sign of that is to break higher here, and the more convincing sign of it is to break higher here. This is a great looking base and break of the 200-day moving average, which this particular index / ETF has not seen since July of 2015. So, as I suggested in the beginning of this video, if the financials, if Europe's financials can turn the corner, that could be an indication. And I've said this before in the trades and tutorials using the general stock index, but now looking at the financials, it's even more compelling. If we can break and continue, keep an eye on this ETF. If you've got the real motion indicators, definitely want to keep an eye on those too. But even if you don't have the real motion, I would be keeping a close eye on this. If it falls back, then it's not ready. But if it breaks out, then definitely you're going to want to be watching our KREs, our XLFs, our own banks here as well. And so with that in mind, let me take a look at one more thing, which is the strongest sector, right, in our list of sectors is SMH. So this is where, if the market, this is one place that I would look for the market to crumble kind of unexpectedly behind the scenes. And while I'm not going to say it's already happening, the SMH is in a position where if it breaks down below the 66 level, its real motion has already started to break down. Now, real motion very often will come and trade around the moving average, and then if the market moves back up, you want to, it will follow it back up. All right, but just as I've said with the IWM, just as I've said with the SPYs, if the SMH is the leading index, and certainly the premier group to be in ever since Brexit, right? Which again, you could see this confirmed it there. This has confirmed all of the moves from the February lows. All right, every time the price went over the moving average, the momentum has been right there with it. If that doesn't happen, right, if SMH momentum does not really break above the 50 and SMH rallies to the highs, that's going to be a new high or a high in the SMHs that you're really going to want to be suspect of. All right, so it's not all there yet. We could simply work our way higher. And if the financials continue to pick up some momentum, and especially now you can see that the European financials have got some momentum behind them, that could be what really moves the market higher. But given the election is so close, it's possible that we could just stay in this funk until the election is over. That said, everything that I've just said right now is not going to change after the election. All right, those levels are critical. The momentum on these particular indexes are critical. Keep an eye on it. And with that, I'll conclude, and I will see you, or Keith will see you, next week in the next Market Outlook.